Let's get into those employment numbers today. And the unemployment rate was forecast to come in at 4%, down from 4.1% in January. Instead, it's way lower, 3.7%, as more than 116,000 jobs, most of them full-time, as you can see, were created in February. The long-term chart shows that unemployment is lurching lower, back towards its 50-year low of 3.4% from the middle of last year. The new jobs boom is right across Australia, but most notable, perhaps, are South Australia and Western Australia, and both of those are the nation's strongest housing markets over the past year. The Reserve Bank forecasts unemployment at 4.2% by this June and 4.3% by December. Governor Michelle Bullock only yesterday suggested unemployment should trend higher before rates here go lower. That's important.
I don't want to put a figure on the unemployment rate that we would like to sort of see. I think the unemployment rate is something that is mechanically going to rise as the economy slows.
So let's bring in here Warren Hogan, independent economist and a consultant for the small business lender Judo Bank. Warren, you heard from the governor there saying, I don't want to be prescriptive about this, but we expect it to trend higher. It's doing exactly the opposite. How does the Reserve Bank behave?
Well, they're not going to like these numbers. I mean, look, it's great to have job creation and low unemployment, but we've got an inflation problem, so it's really not great timing. It confirms there's strong labour demand in the economy, there's labour shortages, there's heaps of spots that need to be filled, and of course this strong population growth is feeding that demand and it's creating jobs, and we saw a lot of full-time jobs. So this number was really strong. It's going to make the RBA very nervous, and it makes them look very wise in not ruling anything in or out, because this narrative that the next move in rates is down is no done deal.
OK, so does that mean that the next move in interest rates could be up and not down? You've talked about this before, but does this number today put a rate rise back on the table?
It certainly does. I don't think the market will start talking about it like that, but for me this is a data point about how the economy is performing early in 2024. It goes along with a few other data points, whether it's the earnings season results, whether it's the Judo Bank PMI that came out this morning for March, showing business conditions improving for the fourth month in a row. It's all going the one way. And of course, the RBA needs the economy to remain soft.
Yeah, so we can see that PMI here. So 4 months in a row, that's risen. Business conditions improving. But the second part about this also is, if we go further forward, I think you got more here. You can see employment prospects also improving as well during that time.
Yeah, I mean, we've seen a turnaround in full-time employment. Now, the issue with, there you go, there's the full-time employment trending down, but starting to turn. And really strong part-time. That's the immigration. That's the part-time work coming in through the students and the backpackers. What we're seeing is the economy, the labour market numbers giving us a clean read for the first time in 2 months.
OK, can I ask another question? And the real issue is, if we have a tight employment market, which 3.7% unemployment does suggest, then there's more pressure on wages. That's where the inflation comes from, isn't it? There's not only demand from spending in the economy from all those people employed, but what there also is that there's pressure on wages to rise, and that's where baked-in inflation in our economy comes from.
It certainly is, and the RBA should be worried about this because our labour market is heavily regulated. It took a long time for it to start to react to the high inflation of the pandemic. It is now reacting. And the problem for the RBA is, if we start to see wage setting get up towards 4.5, 5, it's going to be hard to turn that around with all these 2 and 3 year enterprise bargains and so forth. So what we are going to be watching very closely is wages, because they themselves have said it has peaked. Now, if that's right, fine, but we've got to see that happen.
So do you think that the Treasurer, Jim Chalmers, might one day regret his comment that it's such welcome and positive news that we have positive real wages now? Now, for the people, the workers, that's great news, and it is supply and demand, there's no doubt. And if you're on the right side of the ledger, no problems for you. But from an economic point of view, welcoming and wishing for those very strong wage outcomes, that's a very difficult thing for a Treasurer to really want when you're wanting to get inflation under control.
Yeah, well, we've got an inflation problem, and it's domestic, and it's all about that cost pressure that wage increases and labour costs represent. We've got very little productivity, and again, the numbers today confirm that. We had a lot of jobs created, not a lot of hours work going up, so this is a really low productivity economy at the moment still. And of course, yes, the government is actively trying to get the lower end up, which is a great ambition, But is it sustainable and is it at the right stage of the economic cycle?
Okay, so I want to ask you, would you prefer to be living in Australia or New Zealand right now? They're in recession, but their Reserve Bank, as you remember, absolutely hammered them with high interest rates, 5.5% cash rate versus 4.35% here. Would you prefer to be in recession like New Zealand, or would you prefer to be in Australia sitting right now?
Yeah, well, it's a technical recession. Their unemployment rate's still pretty low. They're not seeing a lot of job losses. It's just the economy's trundling along. It's more stagflationary. Their inflation's still sticky. That's why they were talking about potential rate hikes a few months ago. They're not doing it. But look, of course I want to be here because this is a bigger, more vibrant economy. But we have our challenges. And what these numbers today, both the PMI and the employment are showing, is that our interest rate at 4.35% is well below the world interest rate, the US or New Zealand or Canada. And the RBA will be worried every night that this is not the right level and we're not going to get inflation all the way back with a 4.35% cash rate.
Okay, so I mentioned earlier on where they anticipated the inflation rate to be at June and in December. So the fact is now, if there is an interest rate cut, how far off is it?
I actually think it's so far off it's not worth talking about. The RBA aren't talking about it. I think I've got November, I've had November. You can easily push it into next year.